All right, let's get right into it. Today, we're going to decode the strategic thinking behind a professional trading plan for three of the market's heaviest hitters: QQQ, Apple, and Intel. We're going to break down exactly how you prepare for a market that, let's be honest, could go either way. So this is the big question, right? The real challenge for any trader isn't trying to predict the future. That's a fool's game. It's about planning for it. So how do you actually build a solid plan when the market could just as easily rip higher as it could fall apart? How do you prepare to be right and to be wrong before you even risk a single dollar? Well, the answer is you build a playbook. It's that simple. Instead of making one bet, one prediction, you prepare for two completely different outcomes. You build out a full-blown plan for the bullish scenario, and you build a complete plan for the bearish one. This way, you're not reacting with your gut, you're just executing a strategy you already laid out, no matter what the market decides to throw at you. Okay, so let's start with the big picture. QQQ, the ETF that tracks the NASDAQ 100. To really get what's going on here, we first have to understand a really key technical idea. And that idea is the volume profile node. Now, don't let the name scare you. Think of it like a really busy intersection in a city where tons of cars pass through. In the market, it's a price zone where a ton of shares have changed hands. The analysis here points to a massive node for QQQ right around that 595 to 600 area. That zone is a total battleground, which makes it the perfect pivot point to build our two plans around. So the logic here is actually super straightforward. If the price can break out above this high traffic zone, you can say the bulls have won the battle and we just follow the bullish playbook. But if it breaks down below it, well, the bears are in charge and we flip to the bearish plan. It's all about who wins this fight at this one critical level. And here's that bullish plan laid out. The trigger to get in isn't just a quick little poke above 605. The keywords here are break and hold. You want to see real conviction. The stop loss? That's placed right below that key battleground zone at 598, and the targets are all clearly defined levels on the way up. See? Everything is mapped out ahead of time, no guesswork. Now, for the other side of the coin, the bearish plan. Notice this doesn't get activated on a whim either. It needs a specific signal. A daily close below 598 with volume picking up. That's the confirmation you're looking for. Once you get that, boom. The entry, the stop, and the targets are all ready to go. All right, let's shift gears to our next name, Apple. Here we see a plan that actually has a preferred direction, or what traders call a bias. In this case, the playbook is leaning bearish from the get-go, and the whole reason why comes down to another really cool technical feature. And that feature is a low volume gap. You know how the last one was a busy intersection? Well, this is the exact opposite. It's like an empty hallway in a building, or an air pocket. There's just not a lot of trading history there. The analysis points out a gap for Apple between 252 and 247. The thinking is, if the price falls into this gap, there's basically nothing there to stop it from dropping fast. So the primary plan, the main idea, is to watch for the price to hit a wall, to get rejected right at the top of that empty hallway. If you get in there, you have a really clear path down toward those targets of 248 and 242. And the stop loss is placed way up above, which gives the trade room to breathe, but also clearly says, hey, if we get up here, the whole idea is wrong. Now this is probably the most important question in any trading plan. It's fine to have a bias, to have a preferred idea, but you absolutely must have a plan for what to do if you are dead wrong. A good playbook always has an escape hatch, or sometimes even a plan to completely flip your position. And here's the answer. The whole bearish idea gets thrown out the window if Apple can reclaim that 262 level, especially with strong volume. But what's really crucial here is that the plan isn't just to get out of the short trade. The whole bias flips on a dime, and the new plan is to actually go long on a breakout, aiming for much higher levels. That's next-level planning. Okay, our final case study, Intel, kind of brings all these ideas together. Just like the Apple plan, it starts with a preferred bias. But the way to get into the trade here is a little more, let's say, nuanced. So instead of chasing a stock that's already running or shorting one that's falling, the preferred idea here is all about patience. It's about waiting for the price to come back to you, back to a key area of support. This is that classic buy the dip or pullback strategy, and it's all about trying to get a better, safer entry price. Now, for this entire bullish idea to even exist, there is one number that matters more than anything else on the chart: 4440. That's it. That's the stop loss level. It is the absolute line in the sand. If the price breaks below this, the whole bullish idea is considered toast. So this plan actually gives you two ways in. Idea number one is the preferred one, waiting for that patient pullback into the 45.50 to 46.20 zone. But there's a plan B. If the pullback never happens, the entry trigger shifts to a breakout above 49.50. And hey, remember those low volume gaps? The analysis points out there's another one right above 49, which suggests a breakout could move really fast toward those higher targets.
And just like in our other examples, there's a plan for the other side. But for Intel, the bearish plan is basically dormant. It's locked away. It only becomes active if that critical 44.40 level, that line in the sand, is broken on a daily close. Until that happens, all focus stays on the bullish setup.
So we've walked through QQQ, Apple, and Intel. What's the big picture here? What are the core principles, the rules of the road, that we can take away from this whole strategic playbook? Well, first, and this is non-negotiable, always have a plan for up and for down. Second, every single plan needs those three specific parts: your entry trigger, your stop loss, and your price targets. Third, and this is so important, you have to know, before you even get in, the exact price that tells you your idea was wrong. And finally, all those technical concepts like volume nodes and gaps, they're not just jargon, they're the tools you use to find the key battlegrounds where you build these plans. At the end of the day, the goal isn't to be a fortune teller, it's to be a strategist. It's about being a great planner. By defining your rules before the game even starts, you take fear and greed out of the equation and you replace them with a clear, simple plan. The market is going to choose which path it takes. Your only job is to be ready for it. Thanks for tuning in.